Hello. In July, the system liquidity remained positive throughout the month. RBI had to conduct 18 VRRR auctions in July to flush the surplus liquidity cumulatively, amounting to around 4.49 trillion. Indian sovereign yield curve bull steepened as short-term yields eased more due to the surplus liquidity in the system. T-bill rates fell 10 to 15 basis points during the month, and 10-year G-Sec yield fell by 8 basis points to 693. This was due to robust FPI flows post-index inclusion. Currently, the trade rates are around 6.88. Overall, fully accessible route securities attracted significant flows of INR 193 billion in July versus INR 172 billion in June. Sovereign yield curve bull steepened during the month as short rates fell more than the longer rates. High frequency data continues to indicate growth momentum. India's manufacturing and services PMI signaled substantial improvement in business activity. India's retail inflation saw an uptick for the first time in 5 months as it accelerated to 5.08% on an annual basis in June. This was driven by increase in food prices. This is higher than the 12-month low of 4.75% registered in the previous month. However, the upcoming data release for the same can see significant downfall due to the base effect and moderation in food inflation. In US, the FOMC in its July monetary policy meeting unanimously voted to keep the policy rate unchanged at 23-year high. However, the Fed chair has set the stage for central bank's first rate cut in 4 years, as he cited greater progress towards lower inflation, cooler job market that no longer threatens to overheat the economy. Two comments stand out. First, where he pointed out if US inflation continues to fall, a reduction in policy rate could be on the table when Fed meets next in the September meeting. Second, Fed is watching really carefully for sharper labor market downturn. 10-year US Treasury bond yields fell 11 basis points to 4.03 post FOMC meeting. Fed fund futures immediately started to price in a higher probability of 50 basis point cut in the next meeting. In this background, USD-JPY pair has been appreciating steadily during the month from yearly low of around 162 per dollar, and it crossed the key psychological threshold of 155 yen per dollar, the pair's 100-day moving average. This is in line with the divergent monetary policy expectations for both central banks, where FOMC is expected to pivot soon, but Bank of Japan was seen raising rates even after the last rate hike in its July policy. This accelerated the unwind in the carry trades and led to the sharp appreciation of JPY, which is now trading around at 146 yen per dollar. The apparent dovishness in policy and the weaker unemployment rate released later in US triggered the much-quoted sham rule, which strengthened the view of immediate rate cuts by FOMC and led to the US 10-year YTM fall to around 3.8%. In domestic markets, the MPC is expected to keep rates unchanged even when the regions are stacking up for the start of rate cut cycle. This is because headline inflation is still higher than the 4% target of central bank, led by the food inflation. Otherwise, concerns of the hard landing in US economy, record low core inflation, expected fall in food prices, post-monsoon, high real rates, possibly restricting the growth, are all indicating changes in the policy stance soon. In line with these factors, 2 of the 6 members in MPC have already voted for rate cuts in the last policy. For some time now, we have been pointing out that quarter ending September 24 is going to be a period where central bank's pivot is going to have highest probability, both in US and India. Our view in nutshell has been that the RBI is in wait and watch mode with a hawkish pause and liquidity management as its interim focus. A synchronized global growth downturn, an eventual slowdown in India's domestic demand, and contained core inflation will mean the policy focus may shift from inflation control to supporting growth gradually. A lot of this view hinges on the timing of the rate cuts in US. We still maintain the same view. In fact, recent data has increased our conviction. The spread on benchmark 10-year yields over the policy rate has dropped to just 37 basis points, the lowest since 2017. As of now, it is limiting further decline in sovereign yields. We recommend investors with holding period of at least 1 year to consider investing in longer duration funds. The 10 to 15-year segment and longer end of the yield curve stands to gain from any possible rate cuts in the next 1 year. For investors with lesser appetite of duration risk, can consider funds with moderate duration of 3 to 5 years. Thank you.
Mutual fund investments are subject to market risk. Read all scheme related documents carefully.